All attendees are in listen-only mode.
Hello and welcome to today's Premium Account Market Update for February 2017. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances, and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Heim, Managing Director of Investor Signals, have 18 years of experience in the financial services industry, current licensed securities and derivatives advisor. The format for today's presentation, we look at the macro update driving equities. We focus on the ASX top 50 stocks, and we conclude with a portfolio allocation summary and a short-term market outlook for the ASX. The Premium Account Service is a model portfolio of ASX top 50 stocks. We utilise call options to enhance portfolio returns. We operate inside a strict investment mandate, therefore suitable for self-managed super funds, and importantly the assets remain in your name. If you'd like to know more about the Premium Account Service, please contact us on the number on screen or email me direct, leon@investorsignals.com. Moving straight into the US market, up on screen's a graph of the Dow Jones. Now on a forward basis, US earnings seem to be tracking at around about 6% earnings growth, which is the best we've seen across the last 3 years, but still when you consider at least half of that's coming in the form of share buybacks. A big uptick in the earnings came through from US financials, and there's some questions as to whether that'll be repeatable in the March quarter, given that a big part of that was trading related income, and in particular in the context of trading related income was through the bond market, the volatility the bond market experienced in that December quarter. Right now though, we're seeing strong momentum to the upside in the US equity market. It's consolidated for a while there. This is the Dow Jones at around 20,000 points, and then just in the last few days we've seen it start to break higher. If we just have a quick look at the NASDAQ, and then we'll come back to the XJO. So here in the NASDAQ, we can see we've had a breakout from around 5,250 points in the beginning of November, and the index is put on now about 15% from that breakout point. Having a quick look at the XJO before we move into the top 50 stocks. Locally, we've seen our market bounce off the 5,600 support and move up and really take out the prior high, albeit only by a few points, but we're sitting now at around at a high of around 5,833 points. Let's have a look at the top 50 stocks and talk about at an individual level where we see the valuations. AGL up on screen here at the moment. Now they delivered a good earnings result. The market was looking for a slight upgrade in dividends, but even with that, I still have the stock now on about a 3.9% dividend yield. I think that's expensive. We did own it at lower levels. We've taken profit around here at $20 plus the income from the call option, so we've probably missed the gains from 22 to 24, but I think ultimately we'll see the stock pull back and we'll get an opportunity to take another look at AGL. For me, I think fair value is probably more around this $20 to $21, so I wouldn't be a buyer until we see the stock back on those levels. Amcor came out with earnings that were slightly ahead of market expectations, and the stock rallied from $14 up to $15.20, $15.30. At those levels, I still have the stock on at best a 4% dividend yield, about a 3.9% dividend yield on current earnings. Earnings growth around 4 to 5%. It was encouraging when we look out over the next 6 to 12 months, both analysts and the company start to see earnings maybe ticking up to that sort of higher single digit 5 to 10% growth, and that should support a valuation probably closer to our target of around $15.50. So we own it at these levels, but we're selling covered calls and turning that sort of 4% dividend yield into sort of 10 to 12% cash flow and allowing for some capital growth. I still maintain that Amcor has a relatively defensive context to its business, and arguably it deserves a place in portfolios over other names that I think would present more volatility during a down move in the market. So we continue to like Amcor. AMP, look, I don't think there was anything particularly inspiring in this result. I think it's being dragged higher at the moment, just in line with the broader market, but I think it's susceptible to a heavy sell-off. And right at the moment, you can see there on the chart, we're cautious of this lower high structure there in AMP. ANZ, all the banks at the moment are, so when you can think back to the index bouncing off the 5600 level, you'd expect to see the banks bouncing with them. ANZ had a little over a 10% correction from peak to trough there. It's now recovered about 50% of that. We're still cautious on the Australian banks, and that's just simply a function of where we struggle to see revenue growth coming up over the next 12 to 24 months. And we're also very mindful of APRA's intervention, if you like, into the property market and putting on caveats around bank lending, especially into the investor market. So APRA's fairly keen to make sure that the Australian property market doesn't overheat, and in that environment it seems to be a bit of a struggle to see how the banks grow revenue. And we saw that in NAB's financial profit announcement, both at a revenue level and a profit level, and then likewise we saw it in Bendigo Bank's recent results as well. CBA was the highlight, but it was always going to be the case. APA, we're not doing anything here at the moment, still a little bit cautious of the negative technical structure there, and we think that was a stock that really sort of benefited from the low yield environment, and that's just coming into question at the moment. ASX, I think this is just expensive up here. We're now down onto a 4% dividend yield. We know the company probably will grow 5% earnings at best, but I think we could see this earnings result maybe come in on the light side. Fair value for me for ASX is more back under $50 at around 48, but in this bullish market we're seeing it really sort of test the top end of that pricing range or valuation range. Horizon came out with an okay earnings result. The concern here still is that they pay out 100% of their earnings in dividends, and therefore I think the stock's fairly full value up here. We've got the stock trading on close to a 20% PE and roughly around 19 times earnings, but I think it's getting expensive up here. BHP, so we like this. I think there's definitely a place for BHP in portfolios. We own it at these levels. We've had a view that it's consolidating and mostly moving sideways. We've been pretty aggressive with selling the covered calls up at around $27 to boost the income there of BHP. Got the stock now trading on about a 3.5–4% dividend yield. Brambles, so we've played this as a bit of a recovery bounce here. So we were buying back into it at around this 10.20, 10.30 range and selling covered calls up at around $11. The story here is the company was growing earnings at around 8%. They informed the market that earnings are only going to grow at 3%. On that basis, fair value is probably more between $10.50 and $11.50. Don't see it doing too much more than that. So I think it pays to be aggressive with the covered calls over Brambles. CBA. So here's a situation where, like last earnings results, CBA was the standout performer within the banking sector, growing earnings by about 3% versus the others really barely growing revenue at all. So CBA came in slightly ahead of market expectation. I have the stock now on a 5% dividend yield, and again with limited earnings growth, limited profit growth. We certainly saw CBA, a big contributor was their cost control to the increase in profit. So it's reflective of sort of the tough top line revenue growth environment that the banks are in at the moment. But CBA, given that global equities are pushing higher, may very well test the top end of this range, but again it just seems difficult to sort of identify where that ongoing revenue growth comes from. But from a pure technical perspective, you'd have to say that unless the stock reverses back down through sort of this 81 level, probably holds within this range. Our strategy here on CBA is we've sold European call options with a view that we collect the upcoming dividend, and we're looking for CBA to probably settle somewhere back down towards the bottom end of this trading range over the coming month or two. Coca-Cola, so we like this name. We've added it back into portfolios. We think they grow earnings at 3 to 5%. We think it's a little bit defensive relative to just being overexposed to banks and resources. The stock trades on about 18 times earnings, about 4.5% dividend yield. Again, we're complementing this with a tight covered call and boosting that cash flow up to around 10 to 12%. And we're pretty comfortable even in that environment if Coca-Cola just bounces sideways. Computer shares, so this this was one that the market's been quite bullish on, a combination of cost cutting within the business, higher interest rates helping to improve the business, and also their push into mortgage registry markets, as well as obviously the traditional share registry markets, and that's both in America, Europe, in particular the UK, and here in Australia. But at these levels, Computershare's expensive. It's trading about 19 times earnings. It's on a 2.8% dividend yield, and again, it's just hard to see, albeit momentum's clearly pushing higher, how it actually trades higher on a valuation basis. I think it's susceptible to a pullback. CSL, let's get rid of this resistance. CSL's upgraded earnings, so they've gone from 10% earnings growth to 20% earnings growth, puts the stock on about 18 times earnings on roughly a 2% dividend yield, just under a 2% dividend yield. The company has upgraded its dividend or increased its payout ratio a little. We think that sort of CSL probably remains a star performer in the market, and it's a stock that you want to try to keep exposure to. Arguably it's getting pretty expensive up here, and there may not be too much more to the upside before it has to consolidate and move sideways. But when you look out across a 2 or 3 year period, you'd have to continue to back CSL as being a fairly strong performer going forward, especially in an environment where I said it may be that the banks struggle. So trying to find those names that are like the ResMeds, the CSLs, Sonic Healthcare to a lesser extent, but those names in the healthcare space are likely to continue to do well. Caltex, we like this name. We hold it in portfolios. Again, we've been pretty aggressive with the covered calls up here around $32 to drive extra income. Got the stock trading about 14 times earnings on about a 3.75% dividend yield. Maybe they grow earnings somewhere around 6 to 8%, no more than that. So around 32.50 seems to be a safe level to cover the call, sell a covered call and boost that cash flow. Goodman Group, so within this property space, I think Goodman's doing well, always been a leader there. It's on about 17 times earnings on a 3.5% dividend yield. GPT's our preferred investment, growing earnings at around 5% on a 16 times earnings and a 5% dividend yield. Cover it with a call option at around $5. Again, you're turning that 6% yield into 10 to 12%. We see this stock mainly trading sideways. Insurance Australia Group, we had a buy on this as the stock pulled back to around this 550 level. We own it at lower levels. Last time it rallied up, we sold calls at around this 590 level. Again, turning sort of what's normally around a 5% dividend yield into something that's delivering 10 to 12% cash flow. We don't see upside in the stock much above $6, so we're pretty comfortable running that strategy there with the stock moving sideways. Incitec Pivot, this has been a terrific performer, and it's moved higher off the back of general optimism around commodities and the commissioning of their Louisiana plant coming online and under budget. So IPL's delivering good solid earnings growth, got the stock at the moment trading about 20 times earnings and the yield pushing up to around 3%. So for clients that don't hold Incitec at the moment, on the next pullback we'll look to add Incitec into portfolios on a dip. James Hardie, so we've been long this stock on the back of better data coming through on the US housing and construction market over the last sort of 24 months. But for me, just in the last 3 months, I think we've started to see slower growth in that area, and it could be a function of interest rates pushing a little bit higher, coupled with the fact that obviously property valuations have had a big run in the US over the past 5-6 years. And that may be starting to weigh on James Hardie a little, and we're seeing the stock sort of languish at the lower end of this sort of consolidation range from 22 down to 19. So we'd still hold it in portfolios. We've got the call options expiring over the next month or two, and we'll be looking to set those call options even tighter into the middle of the year, with a view that we really probably want to be exiting James Hardie by sort of May, June at the latest. Lendlease, so we've seen this find support at around 13.60 and push a little bit higher. This stock should deliver around 8% earnings growth, trading 14 times earnings on it. So trading 11 times earnings, I should say, on a 4.5% dividend yield. So we continue to like Lendlease and hold that in most portfolios, but again, we've been quite aggressive with the covered call strategy there on Lendlease. Medibank Private, so we see this at support or good value at around 260. This is a cornerstone holding across all client portfolios, but again, we're complementing it with covered calls. We don't see too much in the way of revenue growth or underlying earnings growth, so we have the stock tracking on about a 4% dividend yield, but again, not much in the way of earnings growth there. So at these levels, we see a pretty full value. Macquarie, we've seen this stock report earnings results. They came in as expected, around $2.1 billion, which is about the same on last year. The forward guidance doesn't suggest too much in the way of growth, puts the stock on roughly a 5% dividend yield. We've seen it bounce off this support level, which coincided with the index finding support at 5,600, but a little bit cautious as to how much higher Macquarie can trade in this current rally at the moment. NAB support here at $30. As with all the banks, we sort of feel that maybe they start to run into resistance and struggle to sort of push through this recent high that they're sitting at following the bounce in the index. Newcrest Mining, we can see they've marked on the chart there lower lows, lower highs. We'll keep an eye on that going forward. Origin Energy, we had a buy signal back here at $5, fair value at $7. We've started selling covered calls over the stock. We don't see too much more out of Origin until maybe the back half of this year. I think oil's fully priced at around $50 to $60 a barrel at present. Oil Search, this is one of our preferred energy plays alongside with Woodside Petroleum, so owning this name and selling tight covered calls makes sense to us. Qantas, a little bit concerned about this on the downside. I think it maybe runs into resistance, and if anything, we're looking at that from the short perspective. QBE, with US interest rates creeping higher, the outlook for QBE's earnings begins to improve. We see support at around $12, maybe on a pullback at $11.50, but we generally expect QBE to deliver better earnings than we've seen over the past few years, where the company's had low insurance margins, probably the lowest in the industry, and repeatedly missed earnings guidance. Ramsay Health Care, we think this found support here at around $66. The stock is expensive, but following the correction from 82 back to 66, we saw this as good value, trading on just over a 2% dividend yield at the moment. Rio, as with BHP, pushing up towards the top end of their resistance at the moment, but what we will say, a combination of the share buyback that Rio's announced and strong earnings, you'd have to say that it probably more bumps along sideways rather than has a real meaningful correction to the downside. South 32, earnings disappointed a little today. Scentre Group, I think this is a stock that we hold in portfolios. We've complemented with a tight covered call, so again turning sort of a 5% dividend yield into a 10 to 12% income. We probably at an underlying earnings level see the stock delivering about 3% earnings growth. The stock recently went ex-dividend about 10.5 cents, and it's managed to sort of hold those levels since. Seek, so we like this name, just a bit concerned here of the negative structure playing out in the price, and we'll be interested to see the upcoming earnings result. We're looking for earnings growth at around 10%. The stock trades at about 2.5% dividend yield, but it'll be interesting to see the upcoming earnings result and confirmation around the rate of earnings per share growth that they're delivering there. Stockland's a little bit cautious here on Stockland's. I think it's one of those property companies where I think our preference is Lendlease over Stockland's, so that's the way we're sort of playing the exposure there. Sonic Healthcare, we like this name. We've always had a view that around fair value is about $22, and we've used that as a level to sell the covered calls. The company came out with earnings delivering about 5% earnings growth, which was slightly below market expectations. Some analysts had earnings target growth of around 8%, but again, we've owned it. So it's interesting when you look back at Sonic and really since middle of 2016, the stock's really traded sideways. So it's been a terrific example of where selling a tight covered call over the stock has really helped to boost the returns. So right at the moment we own this in portfolios and sold calls up at around the 22.50 level. Santos, not doing there at the moment. Preference Oil Search and Woodside and Origin as the energy plays. Suncorp, again, we think this is maybe getting to a level where it's ready to run into resistance. We had taken profit, so we owned it at lower levels and we'd taken profit at around this $14 level. We started to see the stock sell off, and then the index has had the bounce, and we're yet to really see the index or these particular financial stocks test their recent resistance and see how they behave. So that'll be something that we'll focus on the Investor Signals blog over the coming days and weeks, just to sort of keep an eye on those trends. Sydney Airport's earnings result came out a little bit below expectations. Stock trades on about a 5.5% dividend yield. We think it still finds support down here, and that's really driven by the fact that we don't feel that US interest rates are actually going to substantially increase. And it's interesting when you look at the 10-year bond yields in the US that even though the equity market's making new highs, the actual yield on the 10-year Treasury sits about 10 basis points below the prior high. So I think maybe that continues to set up okay for Transurban and Sydney, where they should at least hold these levels. So owning it and selling the tight covered call again, sort of turning a 5% yield into a 10 to 12% cash flow. So Transurban's one of those names that we've been buyers of on this recent pullback here at the moment, and we've sold calls generally up at around $11 to $11.50. And turning sort of a 5% yield into that 10 to 12% cash flow. Transurban delivered a good result, and we saw them, as expected, upgrade the dividend to 50 cents on an annualized basis. Telstra, a really disappointing result here. We were looking for Telstra to actually come out and meet their guidance that they provided at their AGM only 3 months ago, and that just didn't happen and disappointed the market. Interesting sort of where ultimate support. I suspect there's a lot of margin pressure in Telstra, where people have been long Telstra and maybe holding it through margin lending or through derivative positions, and today we've seen a real squeeze on that, and that may continue through till tomorrow, but I'd be inclined to see if we saw another really aggressive day of selling tomorrow. It's probably a very good opportunity to buy into Telstra if we see it down at around this 470 level. So we'll be watching that one closely. Treasury Wines continues to perform very well, and this stock was sort of one of the highlights of the earnings seasons again so far. Vicinity Centre's not doing there. Westpac Bank, so as with the other banks, we've seen them sort of fail and had roughly a 10% correction from peak to trough. Has now recovered all that. We'll just have to wait and see how price behaves as it moves closer to this resistance level. Again, the concern that I have with the banks is just where the upcoming revenue growth and profit growth is coming from, and is this just a momentum-driven issue coming from the US equity market, that breakout from 20,000 points in the Dow, which may in fact be a lot of stop loss being triggered in the US equity market, because there doesn't appear to be enough evidence at the moment that the earnings are really meeting the acceleration targets that the market's pricing in at the moment, and that may have complications for how the Australian banks behave once the US, if this breakout from 20,000 is a little bit of a stop raid to the upside, what implications does that have for equity portfolios over the coming weeks or months in Australia? Wesfarmers delivered a great earnings result. Most of that growth came through from Bunnings and the coal division. Coles was slightly better than expected. The market had pretty low benchmark or expectations there on coal's earnings growth. We have Wesfarmers on about a 17 multiple, 5% dividend yield. Forward earnings growth should be about 8%. That should support the stock trading at around this $41 to $43, probably not doing too much more than that. So we own it at lower levels, and we've sold the covered calls up at around $43.50 to $44.50, and I still maintain that's probably the right range to be locking in the extra gains from the call option income there. Likewise with Westfield, this is one of our preferred large cap property plays. We own it at this level. We've sold very tight covered calls. We've just collected the recent 12-cent dividend, and then we're getting anywhere from sort of 25 to 35 cents for the covered call option. So again, we're turning a relatively low yielding stock, 4% yielding stock, into something that's adding 10 to 12% cash flow to the portfolio. Woolworths, so we like this name. We've sold calls up at around this sort of $25 to $26 range. We think that sort of caps the good news. But you know, we've participated in this recovery from much lower levels here in Woolworths. Have that stock now on just under a 4% dividend yield. With Woodside Petroleum, so this is pretty full value here at these levels, trading about 19 times earnings on roughly a 4% dividend yield, and we think it mainly sort of tracks sideways. So again, we've complemented that with a $32 or $32.50 covered call, anywhere actually from $32 to $34 as covered calls over Woodside. We'd be surprised to see it push too much back up through that range. And there we are, back to the index. I'll just conclude with a summary of the XJO, and maybe just to point out something quickly on the Dow Jones. So the index has had a great rally since the middle of last year, continuing to make higher highs and higher lows. This is a pretty bullish structure off here at 5,600, and we have to assume that the market can push higher while this structure is in place. Our concern really comes from the valuation issues in the US, and whether in fact earnings per share growth can accelerate to support the 18-19 times multiple on the S&P 500, and the need for earnings to accelerate up to close to 10% earnings growth over the next 12 months. At least, more, maybe even as high as 14% earnings growth in order for it to substantiate the current valuations. We also find this big volume accumulation here in the index interesting. One argument could be it's a function of money coming out of the bond market into equities and possibly flowing into broad-based equity ETFs. The other explanation could be that we're starting to see a big part of the market getting squeezed and a large amount of stop losses being triggered, especially as the index starts to accelerate from this breakout. But not to read too much into it, I think we have to say at the moment the momentum's very bullish. There are some concerns there around European bond markets, maybe Chinese property market to keep an eye on. And for that reason, we're trying to stay long equities, but doing so by mainly being exposed to defensive names and trying to drive the extra income through covered call options, whilst also starting to look at some minor hedging strategies for portfolios. Thank you for listening in. If you'd like to know more about the Investor Signal service, please give me a call on the details on screen.